Despite healthy growth in revenues and stable asset quality, the bank, which was once the darling of investors, is now being overlooked in favor of its peers. In 2021, it delivered just a 3% return compared to nearly 40% by its rival ICICI Bank. Yes, we are talking about India's largest private bank, which is none other than the HDFC Bank. So the question here is, what's happening with HDFC Bank? But to answer that, we have to understand the bank's journey to the top. And for that, we must go back in time. A time when Indian banking industry was filled with both drama as well as surprises. Before independence in 1947, there were almost 600 banks present in India. In fact, the first bank to be established was the Bank of Hindustan, which was founded in 1770 in Calcutta but was closed down due to the commercial crisis of 1832. In 1881, the Audh Commercial Bank was established, becoming India's first commercial bank in the country's banking history. Eventually, other banks such as Allahabad Bank and Punjab National Bank were established in the 19th century. Interestingly, these banks have survived the test of time and continue to exist even today. In the early to mid 1800s, some other banks like the Bank of Bengal, Bank of Madras and Bank of Bombay were established, but later they were merged to become one as the Imperial Bank, and this again went on to become what is known today as the State Bank of India. Fast forward to the time when India got independence, the banks were nationalized, and finally in 1991, we saw the LPG era, that is, liberalization, privatization and the globalization. In 1993, just a couple of years after the big bank liberalization reforms, India's banking regulator RBI formally invited private players into the banking sector. After going through over 100 applications, RBI decided to greenlight 10 applicants. This included ICICI Bank, HDFC Bank, Axis Bank, IndusInd Bank, among many others. Despite starting on an equal footing, one bank has climbed above the rest over the last 2 decades, and this is none other than HDFC Bank. In the year 2000, shares of HDFC Bank were trading in the range of Rs 20 to 30 per equity share, and by the year 2009, it climbed up to Rs 130 per equity share. From here, in the past decade, the prices have climbed to the levels of Rs 2,200 per share, after which the company decided to announce a stock split, bringing down prices to approximately Rs 1,100 per share. Along with the HDFC Bank, in the past few years, the Indian banking sector itself has progressed very rapidly with the evolution in technology, and now it is not only limited to depositing and lending, but various categories of loans and advances, digital services, insurance schemes, cards, broking services, and many more. As of March 2021, the bank had a gigantic deposit base of over Rs 13.3 lakh crore, which is 40% higher than ICICI Bank. And it has Rs 6.15 lakh crore lying in current and savings account, which is 40% higher than ICICI Bank as well. HDFC Bank's brand value over the past 7 years has grown from $9.4 billion in 2014 to $20.3 billion in 2020. In terms of market capitalization, it stands third in the country, just behind Reliance Industries and Tata Consultancy Services. The growth of HDFC Bank is undeniably inspiring. So inspiring that it leads to the question of what made it the country's best bank. And the answer to this question can be found if we look at the decisions that the bank made between the year 2004 and 2008, when the Indian economy was booming. During this period, banks were primarily focused on growth, and growth was mainly achieved with profits. Since the profits were primarily derived from interest on loans, the banks were in a lending war with their competitors to lend more and more money, and they ended up providing loans to anyone. However, HDFC Bank took a different route. Instead of lending money to anyone or any entity, the bank concentrated on giving out loans to its customers who were having the capability to pay back. In other words, HDFC focused on growth with a pinch of caution. This allowed them to avoid lending to companies with a bad balance sheet and individuals who were less capable to pay back. For example, between 2004 and 2008, when loans were available at low interest rates, which eventually made borrowing cheap, this gave an opportunity for banks to go on a lending spree. Banks started looking for big borrowers, especially those from sectors like steel and power generation. When banks across the country were trying to find infrastructure companies to lend to, HDFC Bank mostly stayed away from financing these large projects in high-risk sectors. Instead, they focused on its low-risk retail customers. The risk-taking decision of HDFC Bank was so brilliant that it was more than willing to lend to Kingfisher breweries, but it refused to bet on Kingfisher Airlines. While many industry experts looked at the bank and said that it simply lacked a risk appetite, other banks kept on lending to big industries, and these big industries were more than happy to keep borrowing money, expecting a greater opportunity in the economy. But that hope did not last long.
Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%. Dow at the same time has fallen about 18%.
Because we're now down 43%.
In 2008, the world was hit by an economic crisis which was caused by US housing bubble and the collapse of investment bank Lehman Brothers. The crisis was so severe that it spread across the globe, with India being no exception. Indian banks witnessed defaults and bad loans go up in their balance sheet, with HDFC Bank being an exception, and this was mainly because, unlike other banks, they were not lending aggressively to infrastructure companies who were the biggest defaulters of that time. When asked about companies' absence of lending to infrastructure companies in a Forbes interview in 2013, HDFC Bank's Executive Director Paresh Sukhtanga said, "It's not that we haven't participated in infrastructure. We probably had a lower concentration of our loans in infrastructure. Risk management, in my opinion, is also about deciding what you want to do and what you don't want to do, whether it's with infrastructure or with other segments, and then doing it better. So, I don't think our strategy has been to avoid taking risks. I think we have been taking risks when we were aware of the risks and when to take those risks." End quote. In other words, the bank's strategy has not been about avoiding taking the risk, but rather taking calculated risk. If you remember anything from that period, you'll know that power and infra companies were some of the worst defaulters. Companies like Suzlon Energy Limited, GMR Infrastructure were among the list of many. By the time lending war came to an end, banks realized that it was already too late. Banks began to pile up unpaid loans primarily because these companies couldn't pay them back. HDFC Bank, on the other hand, was growing at the same rate as compared to other private banks at the time. However, once the number of loan defaults started to rise, HDFC grew at a much faster rate than other private banks, since a large portion of HDFC's loans were simply made out to the retail public, which included people like you and me. Adding salt to the wound, the rise in defaults only deteriorated the lending abilities of other private banks. While these banks were left to sort themselves out, HDFC Bank was climbing new heights. In fact, the situation was so bad that other banks had no choice except to give time to its defaulters, expecting a repayment, since forced repayment was not a viable choice. Finally, in 2016, the Reserve Bank of India decided to make these banks to recognize their non-performing assets through an asset quality review. Now, non-performing assets are assets that are recorded on a bank's balance sheet after a borrower has failed to pay for an extended period of 90 days. When this happened, multiple banks were forced to recognize their NPAs that they have been hiding in the books for too long. The numbers that came out shocked the banking industry, where banks like Indian Overseas Bank had 20.26% NPA compared to just 1.07 for HDFC Bank. While this appears to be a success story for HDFC Bank, it was rather a disaster for its competitors due to the reckless process they followed. But having said that, the HDFC Bank's performance in the last 2 years was not as great as it used to be. In December 2020, after multiple complaints from customers, the RBI ordered them to halt its digital banking initiative and freeze credit card issuing until it addressed the multiple glitches on their internet and mobile banking systems that has been going on since 2018. Another troubling point for investors to note is HDFC Bank's restructured loans. These restructured loans were mainly triggered due to the pandemic. When the nationwide lockdown was implemented, the customers couldn't pay the loan amount due to the moratorium. Here, the bank had two choices to deal with this matter. One was to recognize these as defaulters and consider this as a potential non-repayment of the loan. However, this also means that the bank's balance sheet would take a toll. And the other option was to extend the loan term for its customers, that is, to make it easier for people to pay back over an extended period. Here, the second option is called restructuring of loans. And according to Bloomberg Quint, HDFC Bank has decided to restructure loans worth Rs 25,000 crores from the beginning of the pandemic till September 2021. If we compare it with ICICI Bank, they had restructured only Rs 7,900 crores worth of loans during the same period. And the general understanding is that these restructured loans may pose a threat in the long run. That is, they are likely to turn into bad loans. Of course, the bad loans at HDFC Bank may still be the lowest in the industry, which is around 1.47%. However, if you add restructured loans into this mix, you will see non-performing assets jump up to nearly 3.5% of the loan book. These are similar numbers to their competitors as well. So the question is, with the weight of these restructured loans hanging over its head, will 2022 be any different for HDFC Bank? As crazy as it sounds, HDFC Bank always kept the habit of lending to those who are capable of repaying loans. Even though there was a huge amount of loan restructuring, that doesn't take away the fact that the bank always had a cautious footing. For example, 70 to 75% of SME loans are secured. Bank also has a team of promoters, employees, which help the bank in tracking the health of these SMEs. However, HDFC Bank has the highest exposure to unsecured retail credit at 17% of its loan book, compared with 9% for ICICI and Axis Bank. But if we are to judge the bank by just a pandemic effect, that would be too naive. HDFC Bank has set high standards in corporate governance since its inception. From sticking to their commitments to proper book writing, HDFC has never compromised with the banking standards, and all the credit goes to Mr. Aditya Puri, the man behind HDFC Bank, who took the bank to such great heights that today its market capitalization is more than that of Goldman Sachs in the United States. In fact, latest quarterly results shows us that the bank is getting back on track. It reduced the gross NPA to 1.26% and along with that reported a net profit of Rupees 10,342 crores. As an investor, this is one of those times when you can get great companies at a discounted share price, and HDFC Bank is one among them. With that being said, we hope you enjoyed this video, and do let us know what are your thoughts on HDFC Bank in the comment section below. Don't forget to hit the like button and do subscribe if you have watched it till here. We'll see you guys on the next one. Bye bye.